Let me start with what Yvonne in Hong Kong was talking about, which was obviously the conversation around the central banks. You've long pushed for a normalization of rates. You've pointed out the risks involved with the low rate scenario. What do you view, how do you view the comments we've heard from the ECB, the BOE, the Fed just in the last few days, and where that puts us?
I think it's long overdue. You look back over the last 8 years, this policy of zero interest rates and massive quantitative easing was very successful in arresting the crisis, but really a significant disappointment in terms of prompting a normal cyclical recovery. Instead, the balance sheet liquidity injections caused a lot of froth in financial markets, which could be a potential source of financial instability, setting the stage for another crisis. And the sooner central banks get out of that policy, I think, the better. And it looks like they're doing it, finally.
And how should investors be positioning themselves, given that you do have now the central banks, broadly, the BOJ the exception, of course, but broadly now looking to this higher rate environment?
Well, the one thing we've learned from studying Japan over the last 25 years is that even in the absence of quantitative easing, that in a post-crisis environment, long-term rates can stay lower for a lot longer than you think. So the consensus view that we're moving into a significant bear market in the long end of sovereign yield curves, that could be overdone in my view. I wouldn't be aggressively bullish for long-term interest rates, but I would certainly not be significantly bearish either in this juncture, given the low levels of inflation around the world.
Now, you've written about the U.S. China relationship, the trade relationship. You're going to be speaking about that today on your panel. My question is the honeymoon over? We've got Trump saying that China has failed to rein in North Korea. We've got potential arms sales to Taiwan. We've got the Commerce Secretary Wilbur Ross potentially going to be announcing tariffs on Chinese steel. How concerned should we be about a deterioration in the relationship?
Well, a couple of things. One, I have learned never to take President Trump's latest view as indicative of where we're going in the future. He changes in a very whimsical way, and so today's seemingly threatening stance toward China after the North Korea negotiation disappointment could quickly be reversed, especially if the U.S. engages in military activity in Syria. They're unwilling to destabilize on two fronts. But I think the U.S. and China, as I will stress in my session, have a lot to be gained from their what I've called codependence or complementarity, especially if China opens its services sector to the world's most competitive service provider, and that's the United States. There are some threats on steel. There have been threats on Chinese tariffs, all during the campaign last year by candidate Trump. It seems like reason is prevailing, but again, that's always a tough call when it comes to someone like Mr. Trump.
We've had the MSCI, including the A shares in their index. We've got the Bond Connect that's going to be announced shortly. Capital markets are reforming gradually. How much of an opportunity do you see this for investors, or are the risks around corporate governance, transparency, regulation too much at the moment?
Well, the MSCI inclusion is a small step in the right direction. It's really a tiny inclusion of a very small number of Chinese stocks. The Chinese have always said how committed they are to capital market reform, and yet in the last couple of years, there's been a significant disruption in the equity market. There's still risks in the property market. They've had to reimpose capital controls. Those are all setbacks on the road to capital market reform that the Chinese will still need to overcome with significant opening actions in the years ahead.
What do you make of the deleveraging campaign that we're seeing here in China, whether that's the money market rates being edged up or whether it's the clampdown on offshore bond issuance by some of the corporates here, some of the local government financing vehicles? How do you see that playing out?
Look, the Chinese authorities are very focused on deleveraging, as they should be. not only are debt to GDP ratios high for corporate China, but they have risen sharply. It's the speed of the rising, mounting indebtedness that has been so worrisome in China. And the government seems to be very serious right now, but as is always the case in China, when they take restrictive moves and there's signs of a significant impact on economic growth, then they tend to back off. So far, the economy is holding up very well. If it does start to break to the downside, I suspect they'll temper the intensity of the deleveraging campaign. But it's a risk that certainly needs to be addressed.
You've spent a long time in Hong Kong in your role as chairman of Morgan Stanley Asia. Where do you see the city's future in the next 10, 20 years?
I think the next 10, 20 years are still quite secure for Hong Kong as China's window to international capital markets, given the talent pool, the institutional framework, and the well-established companies that have been dealing there. I think beyond that time frame, you can raise some serious questions about the future of Hong Kong, given the growth of financial markets in places like Shanghai. But I think for the 10-year horizon, 20-year horizon that you asked about, Hong Kong still has a very important role to play.